This blogger shared images of old solar equipments, lamenting what was once in high demand is now unwanted, even as scrap. The scene is from a warehouse in Kunming, Yunnan, where 90,000 solar tubes have been stored for 3 years, with no idea when they might sell. The once world-leading provider of photovoltaic solutions, Yingli Energy Technology Group, has now gone bankrupt, and its premises are deserted, leaving only sighs of regret as one looks at the empty workshop. In Chuzhou, a photovoltaic plant has shut down. Workers are seen waiting around the factory area, some even lining up to complete formalities. This is the current state of the photovoltaic industry, plagued by severe internal competition. In his video, this blogger filmed the photovoltaic factory he worked at and revealed that he woke up to find himself unemployed, having been caught in the massive layoffs in the photovoltaic industry. One workshop has already closed at the Yiwu Jinko factory, and the last one is expected to shut down after the new year. The Chinese photovoltaic industry is facing severe internal competition, marked by fierce price wars, company closures, and layoffs. Recently, TCL Zhonghuan, a listed company under the Chinese photovoltaic giant TCL, has reported losses for 2 consecutive quarters. It has accumulated over 3.5 billion yuan in losses in 6 months. The net profit for 2023 fell short of the lowest expected value by nearly 800 million yuan. The news of TCL Zhonghuan's performance disaster has garnered widespread attention. An industry insider lamented, "A new era is coming. Who would have thought the downfall of silicon wafers would come so quickly?" In fact, since last year's start of the photovoltaic price war, it was a clear sign that the industry, strongly supported by the Chinese authorities, was irreversibly heading towards decline. In June 2023, the so-called dual giants of silicon wafers, TCL, Zhonghuan, and LONGi Green Energy, both announced further price cuts, with all models of silicon wafers dropping by 20 to 30%. At that time, the price of silicon material had already been halved compared to the peak prices in 2022. The consecutive price cuts by the dual giants were interpreted by the market as a sign that the price war had fully begun. Mao Tingting, a photovoltaic analyst at Shanghai Metals Market, predicted in April last year that the price war in the photovoltaic industry was an inevitable outcome of rapid development. Investors, seeing opportunities for excess profits, made significant investments in building factories for silicon materials, auxiliary materials, and cells. This influx of capital led to severe oversupply in the market. Some analysts also pointed out that many companies hastily followed the government's ambitious goals and invested heavily in production without proper market economic strategies, making failure inevitable. TCL Zhonghuan, a subsidiary of the TCL Group, focuses on residential, commercial, and industrial distributed photovoltaics and overseas business. It is hailed as a global leader in silicon wafer manufacturing. LONGi Green Energy Technology Company is the world's largest solar silicon wafer manufacturer, once vowing to lead the world's most valuable solar technology. TCL Zhonghuan and LONGi Green Energy Technology are leading companies in China's solar product development, considered the epitome of smart factories and benchmarks of advanced manufacturing in China. The Chinese photovoltaic industry has experienced a wave of expansion, according to the China Photovoltaic Industry Association. In 2023, the production of polysilicon, silicon wafers, cells, and modules increased by over 64% year on year. The association's statistics show that in 2023, the supply capacity of the photovoltaic industry reached 1,003 gigawatts, while market demand was about 550 gigawatts, nearly doubling the supply capacity over market demand. According to Sina Finance, despite TCL Zhonghuan's annual losses and continuous price reductions, production has not decreased. An employee of a TCL Zhonghuan subsidiary said their factory was running at full capacity. "It's always full production. We never stop the machines, even during the new year. We work overtime." Others mentioned that their factory had just installed 20 new slicing machines this month. Reports indicate that TCL Zhonghua and LONGi Green Energy Technology are willing to risk collapsing themselves to crush other competitors, striving for survival. Chu Fang, an investment advisor at Wanlian Securities, told Securities Daily that not only in the polysilicon segment, but most segments of the photovoltaic industry chain have already fallen below cost prices. The entire photovoltaic industry chain has reached a stage where competition is based on costs, technology, and cash flow. Companies without these advantages will find it difficult to survive, and high costs and outdated capacities will be quickly eliminated. Since the beginning of this year, the prices of silicon material, silicon wafers, cells, and modules have continued to decline. Even global Chinese solar product companies are facing this downward spiral. The severe competition within the photovoltaic industry has drastically increased survival pressures. The overcapacity in photovoltaic products has overwhelmed overseas companies and severely impacted many Chinese enterprises. Since LONGi Green Energy Technology significantly slashed prices last year, its stock price has plummeted by about 70% from its 2021 peak, with the company's market value evaporating by over 200 billion yuan in 2023 alone. According to the latest data, LONGi Green Energy Technology's revenue in the first quarter of 2024 was 17.67 billion yuan, a 37.59% year-on-year decline. The company reported a net loss of 2.35 billion yuan for the first quarter, with falling prices for modules and silicon wafers. In 2023, its net profit was 10.75 billion yuan, down 27.41% year-on-year. Tongwei Company, a subsidiary of the Tongwei Group, is a large multinational company focused on the synergistic development of green agriculture and green energy. Despite its ambitious goal of changing the world with photovoltaics, it too has suffered from declining prices and overcapacity. Recent data shows that Tongwei Company achieved an operating income of 19.57 billion yuan in the first quarter of 2024, down 41.13% year-on-year. The company posted a net loss of 787 million yuan compared to a net profit of 8.6 billion yuan in the same period last year. TCL Zhonghua's 2023 performance was also grim, with profits halved. The company's annual revenue for 2023 was 59.15 billion yuan, down 11.74% year-on-year. The net profit attributable to the parent company was 3.42 billion yuan, down 49.90% year-on-year. In the past 6 months, TCL Zhonghua has lost a total of 3.5 billion yuan. The TCL Group, a Chinese telecommunications manufacturing company, was formerly a Sino-foreign joint venture known as TTK Home Appliances Company, headquartered in Huizhou, Guangdong. Since Li Dongsheng, a graduate of South China University of Technology, became the chairman of the board of directors and chief executive officer of TCL Technology of TCL Group, the company has grown significantly as it became a joint stock company. Over nearly 3 decades, TCL Group has become Guangdong Province's largest industrial enterprise and one of China's most renowned brands. Its products include home appliances, communications, information, and electrical engineering. The group is currently the leader in China's domestic TV market and one of the top 3 home computer companies in China. After expanding into high-end mobile phone production, TCL is now the leading mobile phone manufacturer in China. Just days before China National Radio reported TCL Zhonghua's disastrous performance, TCL Group renamed its subsidiary Guangdong Homa Group to Guangdong TCL Smart Home Appliances, making it the 4th listed company under the group after TCL Electronics, TCL Technology, and TCL Zhonghua. This led investors to believe that TCL Group's economic performance was rebounding spectacularly. In recent years, there have been rumors that TCL Group has been continuously incurring losses, with the market values of its 3 listed companies hitting new lows annually or lingering at low levels, offering minimal returns to investors. The recent performance released by China National Radio confirmed these rumors, raising concerns about the TCL brand. According to China National Radio, as of the close of trading on April 26, 2024, TCL Zhonghuan's stock price and market value have been drastically reduced from the previous highs to an extremely low level. In April 2023, the stock price peaked at 40.1 yuan per share, but a year later it dropped to 10.44 yuan per share. In July 2022, the market value exceeded 200 billion yuan, but within less than 2 years, it evaporated by 150 billion yuan, leaving only 42.2 billion yuan. The recent praise from the Chinese government and state media about the export growth of the new three in foreign trade, electric vehicles, solar cells, and lithium batteries, has sparked concerns in the United States and Europe. China's photovoltaic products dominate the global market, with 2022 data showing over 75% market share for solar modules, around 80% for solar cells, and over 95% for silicon wafers. The U.S. and Europe accuse the Chinese government of heavily subsidizing state-owned enterprises, leading to overcapacity and dumping cheap products in their markets. This practice is said to undermine fair competition and cause the closure of related businesses in the West. However, the Chinese government denies these accusations. Unfortunately, the truth has come to light. Since the beginning of this year, media reports have continuously highlighted the negative effects of overcapacity in China's photovoltaic industry. Even the world's largest photovoltaic company, LONGi Green Energy Technology, has admitted plans to lay off workers due to cost-cutting measures amid industry overcapacity and fierce competition. Bloomberg reported on March 18 that LONGi Green Energy Technology, to reduce costs, plans to lay off nearly one-third of its workforce. The company, which had about 80,000 employees last year, will see over 24,000 people facing unemployment. The layoffs began in November last year, with thousands already laid off, mostly management trainees and factory workers. LONGi Green Energy Technology later issued a statement denying the 30% layoffs rumor, stating that the actual personnel adjustment ratio would be about 5% of the total workforce. Additionally, according to Huaxia Energy Network, as of the end of September 2023, the total debt of 118 photovoltaic companies reached a staggering 1.76 trillion yuan, with 24 companies having a debt ratio of over 70% and 4 companies over 90%. China's industry media, Solar Star, reported that since October last year, numerous photovoltaic projects in China have been delayed. This affected all segments of the photovoltaic industry chain, including industrial silicon, polysilicon, photovoltaic cell equipment R&D, and distributed photovoltaic power stations. Companies such as Daqo New Energy, Jingshan Light Machine, Inner Mongolia Ojing Science and Technology Company, and Anhui Technology have all announced project delays, including those with strategic cooperation agreements with local governments. Industry leader JA Solar Holdings predicted at the end of last year that second and third tier companies would have to reduce production, stop production, or even exit the industry within 6 months to a year. Industry insiders estimate that many photovoltaic manufacturers will be eliminated in the next 2 to 3 years. According to Cai Qing, overcapacity caused a sharp drop in prices across the photovoltaic industry chain in 2023, with silicon material prices falling by more than 70% and module prices hitting historical lows. Manufacturing companies had to sell solar panels at or below production costs. An analytical article published by China City Network in January of this year stated that the overcapacity in the photovoltaic industry is due to various factors. These include expansion by photovoltaic companies, oversupply, and rapid technological iterations, which led to inventory backlog and supply-demand imbalances. Additionally, small, medium-sized enterprises and cross-industry entrants blindly entered the photovoltaic industry without effective planning and management, contributing to the overcapacity. Silicon wafer companies tried to dump excess products worldwide at ultra-low prices, but were blocked by Western governments. Germany's Handelsblatt reported that in 2023, the Chinese government provided subsidies equivalent to 120 billion euros for the solar industry, directly causing large-scale overcapacity. After China provided massive subsidies to its solar industry in 2012, the EU imposed tariffs on Chinese imports to limit unfair competition. However, in 2018, the EU lifted these restrictions to increase the number of renewable energy installations. The following year, the European Commission declared China a systemic rival and called for investigations into companies receiving substantial Chinese government subsidies. Despite this, the EU has not reinstated these measures, although it has recently urged European companies to reduce the risks of the Chinese supply chain. According to the Financial Times, in September last year, the European solar industry warned the European Commission that an influx of cheap Chinese imports was pushing some manufacturers to the brink of bankruptcy. The situation is hindering the EU's efforts to promote the production of local green technology. The European Solar Photovoltaic Industry Alliance stated that the cost of manufacturing solar modules in Europe is more than double the price of existing Chinese stock. On January 17th, Swiss photovoltaic module manufacturer Meyer Burger announced that it would close its photovoltaic module factory in Germany, the largest in Europe, as early as April unless the government provides the promised financial assistance to help Europe's photovoltaic industry remain competitive. In addition to Meyer Burger, several European photovoltaic companies, including Norwegian silicon wafer manufacturer Norwegian Crystals and Norwegian solar company Norsen, have announced production halts or layoffs recently. Beyond Europe, South Korean photovoltaic company Hanwha Group announced the closure of its domestic factory last year and shifted its focus to the U.S. Additionally, Singapore-based vertically integrated photovoltaic manufacturer REC also announced the closure of 2 polysilicon production plants. Facing the strong challenge of Chinese manufactured green products, U.S. Secretary of Treasury Janet Yellen visited China in April this year.
Our administration's approach.
Her primary task was to address the impact of China's overcapacity on the U.S. and the global economy. Yellen expressed concerns to Chinese officials about the negative effects of overcapacity on other countries' producers during her meetings with Vice Premier He Lifeng in Guangzhou and Premier Li Qiang in Beijing. Yellen stated the overproduction of Chinese electric vehicles, solar panels, semiconductors, and other products flooding the global market is detrimental to China and harms producers in other countries. Rhodium Group believes that the surge in exports of China's new energy industries, such as electric vehicles and solar cells, over the past few years could be devastating for producers in developed economies facing market constraints. In the late 1990s and early 2000s, the U.S. and the global economy experienced a shock from an influx of cheap Chinese goods, resulting in a decline in local manufacturing jobs. More than 20 years later, a new wave of cheap Chinese products is once again flooding the world. So how did this characteristic overcapacity under the Chinese Communist Party, or CCP, come about? The root cause of the CCP-style overcapacity lies in the CCP and its government acting as the main directors of economic activity and resource allocation. This command economy leads to market failure and a disruption of the price signaling system. The government's industrial policies are entirely based on administrative orders rather than market mechanisms. The government replaces the market in resource allocation, making decisions on projects and constructions based on whims. State-owned enterprises under the CCP's direction enjoy all the advantages of tax benefits, credit access, government subsidies, and sales channels. When losses occur, there is no accountability, with state assets and taxpayers bearing the brunt. CCP-style overcapacity is a chronic system issue in China's economic development. During China's 40 years of reform and opening up, the CCP leadership long used GDP and physical revenue as key performance indicators for local officials. This GDP-centric approach led to highly politically motivated industrial policies. Investment-driven economies were favored by officials, allowing for both corruption and the opportunity to achieve impressive political results. Even in the face of overcapacity, as long as there were high investments and high taxes, CCP officials would lower industry entry barriers and provide substantial fiscal subsidies and various preferential policies, disregarding market demand and profitability. A prime example is the steel industry. From 2006 to 2015, China's steel production capacity increased from 1/3 to half of the world's total. In 2015, China's crude steel production was more than 10 times that of the United States. Overcapacity in the steel and coal industries created numerous zombie enterprises. In 2015, as China's economic growth slowed, the CCP had to spend heavily on capacity reduction. They forced companies to repay debts, lay off large numbers of employees, and undergo so-called economic transformation and structural adjustment. After Xi Jinping's administration reverted to a planned economy approach, China's economy entered a rapid decline. To counter the economic downturn caused by the crackdown on real estate, the CCP introduced the concept of new quality productivity, elevating industries such as new energy vehicles, lithium batteries, and photovoltaic power to drive economic growth. However, the heavily subsidized New 3 are becoming a new threat to manufacturing in the U.S. and EU countries. In response to CCP-style overcapacity and global dumping, the U.S. and Europe have implemented anti-dumping tariffs and banned the import of products with the most severe Chinese government subsidies. Under the CCP's directives, enterprises have experienced production cycles of rapid expansion followed by sharp declines, often leading to the brink of bankruptcy.